As of right now, the U.S. markets are closed for the Thanksgiving holiday, but looking at the final closing data from the last active trading session, NVIDIA Corp's stock is sitting at exactly 180.26 USD, having secured a gain of 2.44 points or 1.37% by the closing bell. If you are staring at your screen wondering why the price didn't explode higher or crash lower given the sheer volume of news circulating this week, you are not alone, but you might be looking at the wrong signals. The expectation, right now, perpetuated by endless headlines and forum chatter, is that NVIDIA is facing a cliff edge, that with the launch of Google's Gemini 3 and Elon Musk's aggressive claims about Tesla's chip manufacturing capabilities, the moat is finally drying up. Investors expect that the triple-digit growth days are over and that we are entering a period of stagnation where the stock chops sideways while competitors catch up. That is the expectation. The reality, however, is far more aggressive and significantly less comfortable for the bears. The reality is that we are seeing a massive silent rotation where weak retail hands are selling out of fear of competition, while institutional giants are quietly absorbing that liquidity because they know that the $57 billion revenue figure reported for Q3 isn't a peak, but a baseline for a new kind of sovereign industrial complex. When we analyze the price action leading up to this holiday break, particularly that 1.37% move to 180.26, it looks modest on the surface, but the volume profile tells a different story. We saw over 180 million shares change hands in the last session alone. This is not the behavior of a stock that is being abandoned. This is the behavior of a stock that is being accumulated. Retail traders using the Robinhood app or engaging in Robinhood stock trading might be looking at the 15% correction from the October highs of $212 and seeing a warning sign. They see the chart dipping and panic, thinking the AI bubble argument is finally validating itself. However, if you look at the block trades and dark pool data utilized by institutional clients on Interactive Brokers trading platforms or within Fidelity Wealth Management divisions, you see a floor being established. The smart money is treating the $175 to $180 range not as a ceiling, but as a rigid support level. They are betting that the market has fundamentally misunderstood the nature of NVIDIA's competition. The narrative that Tesla stock or Apple stock creating their own chips will kill NVIDIA is flawed because it assumes chips are a zero-sum commodity. The reality revealed in the latest earnings, where data center revenue hit $51.2 billion, is that the demand for compute is expanding faster than the collective supply of the entire planet. NVIDIA isn't just selling chips anymore. They are selling the only viable infrastructure for nations and megacorporations to remain relevant in the next 10 years. Let's talk about that competition narrative, because it is the single biggest weight on the stock right now. You have likely read the reports that Google is talking to Meta about TPU chips, or that Tesla stock is rallying because Musk claims they will outbuild everyone. This creates a wall of worry for the average person doing online investing or looking for investment help. It feels safer to diversify away from NVIDIA. But here is the contrarian take you need to consider. The arrival of custom silicon from hyperscalers like Microsoft and Google actually validates NVIDIA's roadmap rather than negates it. When these companies build their own chips, they're building them for very specific, narrow workloads to save costs on the easy stuff. For the heavy lifting, the training of massive next-generation models like Gemini 3 or OpenAI's latest iterations, they are still lining up to buy every single Blackwell chip NVIDIA can produce. Jensen Huang confirmed that Blackwell is sold out and demand is off the charts. That is not corporate speak. That is a supply constraint in the face of insatiable demand. If you are using Schwab Intelligent Portfolios or managing your own Fidelity IRAs, you have to ask yourself, if the competition is so fierce, why are NVIDIA's margins holding above 73%? In a true price war, margins compress. NVIDIA's margins are stable. That tells you they still possess pricing power that no one else has. We need to look closely at the mechanics of the market right now. The recent price action has been choppy, and that scares people who are new to self-investing or using investing sites for the first time. Volatility feels like risk. But in this case, volatility is the mechanism of price discovery. The stock is digesting the fact that it is now a $4.5 trillion entity. It cannot double every month. What it is doing now is compressing its valuation. The price-to-earnings ratio has actually come down significantly to around 44, making it cheaper today on a forward earnings basis than it was when the stock was at $100. This is a critical insight for anyone using SoFi Invest or checking their SoFi active investing accounts. You are paying less for every dollar of NVIDIA's future earnings today than you were a year ago, despite the stock price being higher. This earnings compression is the hallmark of a maturing superstock that is transitioning from a speculative mania into a fundamental juggernaut. It is similar to what we saw with Apple stock in the mid-2010s, a period where the stock stalled while the earnings caught up, eventually leading to the next massive leg up. There is also a geopolitical angle that most Fidelity brokerage reports gloss over. The sovereign AI thesis is becoming the primary driver of the next leg of growth. We are no longer just talking about companies buying GPUs, we are talking about countries. The UK, Japan, Saudi Arabia, and others are treating compute power as a national security resource, stockpiling NVIDIA hardware the way they used to stockpile oil reserves. This is a completely price-inelastic source of demand. A nation-state does not care if the Blackwell chip costs $30,000 or $40,000. They care about national survival. This shift insulates NVIDIA from the typical corporate budget cycles that worry analysts. If you are sitting on your Fidelity mobile app or browsing Robinhood fractional shares thinking about selling, consider that you are selling right before the sovereign spending wave truly hits the balance sheet. The $57 billion revenue figure for Q3 included the early stages of this, but the real volume comes in fiscal year 2027. Now, I want to pause for a second and get a sense of where you stand in this chaotic market. Comment below how many shares of NVIDIA you currently hold, or if you are waiting for a dip to enter. Are you holding through the volatility, or did the recent drop to 175 shake you out? I want to see if the sentiment in the comments matches the fear I am seeing in the headlines. Getting back to the analysis, we have to discuss the risks because being blind to them is the fastest way to lose money in individual brokerage accounts. The biggest risk is not AMD or Intel. It is the supply chain concentration. We know that TSMC is the bottleneck. If anything happens in Taiwan, or if there is a yield issue with the advanced packaging required for Blackwell, the stock will react violently. We saw a glimpse of this when the stock dropped on overheating rumors a few months ago. Investors using Interactive Brokers platform tools to hedge their portfolios often use put options on NVIDIA specifically to protect against this geopolitical tail risk. It is a valid concern. Furthermore, the regulatory environment is hostile. The DOJ and global antitrust bodies are scrutinizing every move NVIDIA makes. While they likely cannot break the company up, they can slow down acquisitions and create headlines that cause Robinhood crypto traders and equity traders alike to panic sell. You need to be prepared for headline risk, where the stock drops 5% in a day on a rumor of an investigation, only to recover a week later when the fundamentals reassert themselves. Let's pivot to the institutional landscape. If you track the flows from major ETFs, specifically Fidelity ETFs and Fidelity mutual funds, you will see that they are legally obligated to rebalance. Because NVIDIA has grown so large, many funds hit their concentration limits and are forced to sell shares simply to stay compliant with their own rules. This creates artificial selling pressure that has nothing to do with the company's performance. This is often what stops the stock from breaking through that $212 high. It is structural resistance. However, once the calendar year resets and new allocation mandates kick in for 2026, that selling pressure often abates. For those of you utilizing investment strategies through Schwab Intelligent Portfolios or similar robo-advisor services like the SoFi Robo-Advisor, you might notice your portfolio automatically adjusting. Understanding that these are mechanical moves, not fundamental indictments of the business, gives you an edge. You can sit tight while the algorithms churn, knowing the long-term thesis is intact. Another massive factor is the software ecosystem. Everyone talks about the chips, but few talk about CUDA. The reason Tesla stock or Amazon can't just switch off NVIDIA tomorrow is because millions of developers have spent 15 years learning NVIDIA's software language. To switch to a Google TPU